Oil is one of the most popular and most traded commodities in the world. Oil is an extremely important commodity for the global economy. We use it and its distillates for the vast majority of the transportation in our economies. That means airplanes, ships, buses, and cars need oil or its distillates like gasoline, jet fuel, diesel, plastics, petrochemicals, and petrol to run. Without oil, the global economy will grind to a halt. As oil is consumed in such vast amounts every single second of every day, rapid changes in its price can drastically affect cost pressures across the supply chain. When input costs are affected, either higher or lower, it has big ripple effects across the economy. For this reason, market participants spend a considerable amount of time assessing the key drivers for oil prices, which we will discuss in this section. Now, there are 5 key drivers for oil prices, namely the US dollar, supply, which has 4 subsections like OPEC+, inventories, weather, and geopolitics. Then we also have demand, and finally we have inflation and risk sentiment. Let's start with the first one, which is the US dollar. Now, the data is very clear that the US dollar shares a long-term correlation with commodities with a negative 35 10-year average inverse correlation. Do take note that it's mostly cyclical in nature, and there will be times, especially in the medium term, looking at things like the 3-month correlation, when individual commodity drivers like inflation, demand shocks, supply shocks, etc. can see both the dollar and commodities move in tandem with each other. So the best way to approach the dollar with regards to commodities is to assess what the main driver is at that time. For example, if there is a supply shock in the global economy, much like we saw during the COVID-19 pandemic and then exacerbated by the Russian invasion of Ukraine, we can see both the dollar and oil prices moving up in tandem. So even though the inverse correlation between WTI and the US dollar is always important to remember, it won't always be the main driver. As the US dollar and global growth is usually inversely correlated, the demand outlook plays a big role in the outlook for oil prices, which brings us to the next key driver, and that is the global demand outlook. The global economy needs oil to operate. So when the global economy is booming and everything is going well, there is more growth and there's more expansion. It means more mobility, which requires more oil. This means the health of the global economy is very important for oil prices. When there is more demand from a booming global economy, and especially the biggest oil consumers like China and the US, that is usually a good environment for oil prices to move higher. Vice versa, when the economy is in trouble and slowing down, that sees a big fall in global oil demand, that is normally bad for oil prices. Great examples of how demand shocks can impact oil prices is by looking at what happened to oil prices with every recent demand shock that we've had in the very near term, like the cyclical slowdown for the US in the 3rd quarter of 2018, or the COVID-19 crash in the 1st quarter of 2020, or the strong demand recovery during 2021, and more recently the demand shock from China and a slowing US economy in 2022. That means just like we need to keep track of growth and inflation expectations for asset classes like equities, FX, and fixed income, it's no different for oil prices. Looking at this chart again, we can clearly see the close relationship between things like WTI and equities, with a very similar reaction to the overall demand outlook for the economy.